start off this video straight up with a disclaimer in that basically if you actually really want to know about this business, then watch Mohnish Pabrai video, because he's heavily invested in this and he spoke about it at length in several of his videos in probably a far more better way than I am going to. But it's just going down through the insider buys here today, anything over 200k, and I came across this Alpha Metallurgical Resources Inc. Now, the director, this Kenneth Curtis, has purchased $16 million worth of stock, 108,000 shares, 148.55, an insane amount. So I was already aware that Mohnish Pabrai was in Alpha Metallurgical. This made me think, right, let's have a good look at this and see what we can see if we can come up with a thesis much like Mohnish Pabrai. So his thesis is already out there, so this video is going to be a bit pointless. If you're going to get a better thesis from someone else who's a far more accomplished investor than I could ever hope to be. I haven't even built my first portfolio yet, whereas obviously he's been doing it for years. But I thought, you know what a chance now to look into this company and see if we can see what Mohnish Pabrai saw. So what I have done is already drag the data up. I've basically already done my research on this, so a lot of this is going to be talking through everything that I've said and seen so far. We will start off and say very good balance sheet. Now I believe this AMR is a company, it's going to take me a long time to scroll up here. I believe AMR is a company that came out of a bankrupt stock. Am I right in saying that, or is that something else? Let's just check. Right, where are we? So AMR is metallurgical and thermal coal. It's the metallurgical part of it that Mohnish Pabrai has been interested in, and it's effectively worth more. Metallurgical coal is worth more than thermal coal. I've got both of them up here. This is the metallurgical coal futures, and this here is the thermal coal futures. So clearly worth way more metallurgical coal than thermal coal. Also makes up a much larger portion of their income statement, but we'll get onto that in a bit. So let's just see. There you go. The company merged from bankruptcy of its predecessor, Alpha Natural Resources, which had filed for a Charter 11 in 2015. The merger and rebranding aimed to streamline operations and strengthen its position in the metallurgical coal market. So, because they've been through a reasonably recent bankruptcy, they've managed to keep the balance sheet together really well since then. If we actually look at the balance sheet here, the total long-term debt is literally 3 million. I'll bring it up on the SEC website. So current portion of long-term debt 2 million this year. Payables, accrued expenses, so total current liabilities is nothing compared to the total current assets that they have. They've got 450 million in cash, 300 in receivables come in, 207 million in inventories. So all of their current stuff is more than covered. Now when you get down to this other stuff, obviously this is not stuff that's going to be due all at once, like retirement obligations, pensions. I'm guessing the pensions is there. So what would that be then? Legal obligation is sober disposal, retirement, intangible, long-lived assets. Okay, sorry, asset retirement. I didn't read the whole thing, did I? What an idiot. There you go. This is why you should go and watch Mohnish Pabrai, because this is me and my inexperience and newness to the markets, trying to break down something and see if we can see what a very experienced trader can. But none of this is going to be due, you know, anytime soon, not in its full entirety. So that's what you would have to worry about. So the balance sheet looks really, really good. They got a lot of PP&E, you know, which if they had debt would be good to use. Would mean, you know, there's decent collateral against things, but they don't need it. They've got no debt. The current portion of long-term debt and their long-term debt, they just don't really have any debt. So the balance sheet is pretty damn good. You're not going to come across many balance sheets than this, and I would imagine that a lot of people in this sector have got long-term debts that are huge. So very good balance sheet. Recently, here we go, look, Kenneth S. Curtis, an independent director at Alpha Metallurgical, made a significant insider purchase totaling 16 million. To represent approximately 16% of the company's outstanding stock. That was what I was going to have a look at to see who the holders are, because that's not something I had done yet. So, already on the holders. Delisle Street. Is that Mohnish Pabrai? I thought so. Toll and Company. Toll, I've heard of them as well, because Raw and Kitty mentioned them on on his videos several times. I think they're a value fund. Yeah, there you go, value investment. So there's two value players that we know of that are already in this. 20% of Rise portfolio is in this, and I don't know if his Wagons fund is on here or whether or not that counts as his Wagons fund, but his Wagons fund's got 4%. To be honest, the Wagons fund could be incorporated into this. I don't know. You know, 20% Mohnish Pabrai has got in this. He owns 3% ownership. Let's see what all the insiders total holding. I said this is something I've not done yet, so you are seeing me do this live. I don't try this data, do I? There we go. Let's bring this up. Beneficial. Here. So this must have came out before, or definitely did come out before. This man here purchased more stock. But there's a 10% holder there, look, so that's pretty good to see, isn't it? And if this is correct, what does it say what his total holdings are? Where is he? AMR. I've got to watch this stupid advert, but 734,000 shares. He's up 17% on what he was, by the look of it. So yeah, you know, this is a board where at least some of them are aligned with the shareholders, let's say, especially when you've put 16 million in. Who is this guy? Includes 729 common shares. Okay. Right. So yeah, from this point of view, you've got two funds that we know of. One of them, Mohnish Pabrai, heavily invested in this, which he has spoken about. Like I said, I keep repeating that. And there's a couple members of the board themselves that are, you know, heavily invested. So that's very good to see. So let's just keep going down through the conversation. So there has been, as you can see here, we're on the right one, a huge decline in the price of coal in the last, 18 months, over 18 months. This is the main driver for the decline in revenues, but the global steel industry, and we'll go into that in a bit, the global steel industry faced challenges leading to reduced demand for metallurgical coal, a critical component of steel production. This decline was attributed to slowdown in economic activities and reduced industrial output in key markets. Now, a bit further down, the key markets are China and for AMR, which is very limited in its China exposure, it seems. The majority of the problem that AMR has found is that Europe, particularly places like Germany, have slowed down steel production, so their need for metallurgical coal has dropped significantly. They also believe that it could be down to 107, 101, 107. Depends on what they're on about here. The company suggests its cost of coal sales guidance. And to additionally, what I'm saying, they're trying to streamline their, you can see that they have actually, they're trying to streamline their cost of goods sold and their SG&A expenses, which year on year it has dropped there, and cost of revenues dropped significantly, actually 400 million, which is obviously not enough to combat the revenue loss, which is why they've got negative net income this TTM. But so we'll go into that, because that is basically purely down to the drop in the coal prices, it seems. So we're just going to scroll down through. This is just me asking if I could find out what the coal futures was. Now 95% possibly. There you go. 95% of their revenues are metallurgical coal. So India is a reasonably big market for metallurgical coal, and they're aimed. There you go. It just says right here, more than double steel production capacity from 141 million metric tons to 300 metric tons by 2030. So you're talking another, 4 and a bit years. This ambitious growth is expected to significantly increase demand for metallurgical coal as the country lacks sufficient domestic supply and relies heavily on imports. Countries in Southeast Asia are also expanding their steel production capacities, further driving demand for metallurgical coal in the region. So there's very few. The reason why this will be good for coal prices is there's very few new metallurgical coal mines coming. With only a few projects planned to open before 2030. So this is basically constraining the supply. So yes, there is currently an oversupply of coal, mainly because of China. And we'll go down into that in a bit. But there's also nothing else coming online anytime soon in order to keep that oversupply going effectively. Companies are focused on enhancing the efficiency and capacity of existing mines rather than developing new ones, which is what, like I said, just showing you, we've seen with AMR, in that their cost of revenues dropped significantly and their SG&A expenses have also dropped. So keep going down. So a lot of places are trying to cut down on blast furnaces, which is obviously what metallurgical coal is used in. Electric arc furnace adoption. So this, I believe, is for, electric arc furnace is for recycling steel, which currently there's, as Mohnish Pabrai said, there's currently nowhere near enough, especially in the emerging markets, and of good grade as well. So yes, there is a plan to go away from the carbon heavy metallurgical coal, but it's not something that's going to be able to happen overnight. People are trying to cut their carbon footprint, but it's not something that's going to be able to happen anytime soon, because there's just not the supply of scrap metal of good enough quality available. It's just not currently possible. So given AMR's significant exposure to metallurgical coal, the company's performance is closely tied to the factors mentioned above. So metallurgical coal prices experience volatility due to fluctuations in global steel production and changes in demand from key markets. there's initiatives as well to slow down their carbon footprints, or shrink their carbon footprints. But it's all stuff that's not going to be able to have a high enough impact anytime soon. And then asked how many high quality metallurgical coal mines are there, because AMR's coal mines are up there with the very best quality of metallurgical coal. So apparently there's 6,646 coal mines globally. Identifies 160 companies that are developing new metallurgical coal mines or expanding existing ones. These projects existing plus plans amount to 252 met coal mines / expansion projects. So there are known mines that are considered high quality premium coking coal producers in Australia, and there's 2 there in Australia. According to Statista, planned coal mines worldwide are overwhelmingly thermal coal. Planned metallurgical coal mines represent less than 10% of the capacity in planned mines. So, yes, because China's slowed down on its imports of metallurgical coal, that's obviously not good. But then going forward, less than 10% of it of new mines is expected to be metallurgical coal, which is nuts considering it is needed. The idea that you do not need coal to make steel is ludicrous. It is absolutely needed. So, you could end up at some point in the future, not too distant future as well, where there's just not enough available. There are hundreds of metallurgical coal mines worldwide. Far fewer are high-quality premium producers. Given how many expansions and new projects are identified, plus existing ones, we can reasonably infer that there are likely 200 to 500 high-quality metallurgical mines globally. But because high quality is not uniformly defined or publicly tracked, any number has a wide margin of error. Okay. Alpha Metallurgical is widely considered a premium producer of metallurgical coal, particularly high-quality hard coking coal used in steelmaking. So 95% of their revenues come from metallurgical coal. Most desirable for blast furnaces, though. So with most of their metallurgical coal being low volume, mid volume, and high volume hard coking coal grades, the most desirable for blast furnace steelmaking. So they are right up there for who you would call should you need some. They sell to global steel makers, including Europe, South America, and Asia. What else have we got here? So yes, they are premium producers of good metallurgical coal. So Alpha Metallurgical operates 19 active mines, underground and on the surface. Portfolio consists of 15 underground mines and 7 surface mines, totaling, including both met and thermal. But in the met segment, they are reporting 19 active mines in Appalachia. So 19 mines. And I said, well, okay, so what would it cost today to open up a brand new mine? Like, what would the replacement cost be for one of these mines? Now, small to mid-sized mines, which I believe are what almost all of these 19 mines are, or these 19 metallurgical mines are, cost anywhere between 300 to 600 million. So, pardon me, if we're conservative and say that you're going to use 300 million for the lowest amount, then 300 times, what was it, 19? Cost you 5.7 billion to reproduce what AMR have. Now, it would cost you 5.7 billion to reproduce it, but you can currently buy that capability for 1.7 billion, which is a significant drop, significantly cheaper than trying to reproduce all of that. 5.7 billion or 1.7 billion, 5.7 billion is a replacement cost when you can actually buy that now for 1.7 billion. And not only that, if you were to try and start a new one, permitting in the US can take 5 to 7 years. Environmental and community opposition increases both cost and the timeline. So all very well saying, okay, right, we'll have 5.7 billion. We will, instead of buying this, let's start brand new mines and let's start 19 new mines. You're not going to do it anytime soon. It's just not going to be possible. So I did ask just to see what them, are they small to mid-size or large, just to see what the cost would be. But AMR mines mostly small to medium. So like I said, if you were to try and start 19 new met mines to mimic AMR's properties, it costs 5.7 billion to imitate AMR at the lower end of the 300 million each. But you can't start today, so the cost in 5 years could in fact be higher. It's almost certainly going to be higher. And the company trades well below replacement cost of its mines. At the more realistic so this is the most conservative, right? ChatGPT is saying that the more realistic mid-range cost for these mines, you're talking 9.5 billion. Or, like basically 5x, 5 times more if you were to start this business from scratch than the 1.7 billion it costs you now to do that. So I can see why Mohnish Pabrai from that point of view is very, very interested in this company. 70% lower than the conservative replacement cost. In other words, the market is valuing AMR's entire portfolio of 19 mines plus infrastructure, customer contracts, logistics and workforce at less than 30 cents on the dollar compared to the cost of building new equivalents. So why the discount? Cyclical earnings. Coal prices are volatile, so markets often priced in mid-cycle scenario rather than current high cash flows, which I get. I do get. But if we actually look at when the coal prices were at their highest, let's point this out. It is when the coal prices were at their highest. We're talking up around here, 2022, when demand was really high coming out of COVID. They had over $1 billion in free cash flow. Over $1 billion in free cash flow. You could have, over the course of these 2 years here, 2.2 billion, you could have bought the entire company out just from the simple free cash flows. So this is another reason why Mohnish Pabrai likes this, because I've heard him say several times he would like his investments to be able to pay him back within 3 to 5 years. Now, obviously, this was top of the cycle, but it was possible. It has happened in recent years. So another thing that Mohnish Pabrai has talked about that he likes, and another thing that would be appealing about this should this become an investment. So ESG headwinds. All right. Institutional investors avoid coal, shrinking the pool of potential buyers. This is a problem for investing in coal mines. Is that a lot of people don't want to be associated with the carbon footprint or the perceived carbon footprint, which, as an engineer myself, I think is ridiculous, because the modern world relies on steel. So at the moment, blast furnaces and all that are the most viable way of doing it at the moment. So it's needed. Whether you like it or not, it is needed. AMR looks very cheap on replacement cost basis. Replicating its portfolio today would cost 5.7 to 10 billion, yet the market values it at only 1.6 billion. Scarcity is one of the reasons why high quality met coal producers are sometimes acquired at premiums. So market's essentially saying we don't believe these mines will generate their replacement value before the demand fades, but we've already seen that they've done over 2 billion in 2 years, and you can buy the whole company for 1.6 billion. So, it seems a bit illogical, really, I guess. So global demand for metallurgical coal every year is just over a billion metric tons. Met coal is used in steel production, especially in blast furnace and basic oxygen furnace. Demand is fairly stable, can fluctuate with global steel demand, construction, infrastructure growth, and substitute pressures. So Some forecasts expect slight declines or plateaus in the next few years due to weaker steel demand, economic headwinds, and more efficiency slash substitution. So that is effectively what we're seeing at the moment. China's really cut down on its imports of metallurgical coal, and their steel demand has dropped, as has mainland Europe. So that is where we are at currently, and that is why we've seen this steep decline in the price of coal. There's inventory oversupply due to this period here, and you're dealing with the tailwinds of that now currently. Other major growth centres such as China, India and Brazil currently experience an increased need for steel. So this is where I've got the information I've already told you about. China's steel demand and production have been declining recently. Slump in the real estate property sector, government policy to reduce overcapacity, emissions and energy use regulations, and a shift towards a less infrastructure heavy growth model. For example, forecasts suggest China's crude steel output may decline 1 to 3% in 2025. India and Brazil, however, are the opposite. The steel demand is growing. Now, the problem is China is a bigger importer than everybody else combined. So yes, it's good that India and other, growth centers like Brazil and all that are growing. The problem you've got is that China is bigger than all the rest combined. China's steel demand may decline for another 1 to 2 years while real estate and construction sectors recover, if they recover. India's growth looks more durable. Global steel demand is expected to grow slowly, but it is expected to grow. Many analysts expect China's share of steel coal demand to shrink, India and South Asia to take up more of the incremental demand. So, basically, here's just a table of what's going to happen. Weak property sector is causing China to decline. That's drag on steel met coal demand in the short term. Let's just skip down through this because I'm not sure these parts are relevant. So here's a table summarising the current global metallurgical coal oversupply situation. Exports projected 7% decline in 2025 to 345 metric tonnes. Export supply being reduced, oversupply pressure easing at the seaborne market level. China exporting coke and coal previously imported. So that shows the base. If China is exporting the coke and coal, it means that they don't have enough need for it themselves. Normally, they would be potentially not really exporting if they had a need for it themselves. So basically, it shows that there's a domestic oversupply in China, which is not helping the price of coal. There's pressure, significant price decline from 2022. Producers under margin pressure. So basically, in summary, oversupply is moderating in global exports, but domestic inventories, China, some Asian markets remain high. So this is the problem. This is why you're seeing a drop in the price. So, let's get down to how much does America consume. So, the majority of AMRs is export. We can see that in. Let's get the old NQ back up a minute. Press the wrong things here. Place revenues. So they do thermal coal as well, but it's so insignificant. We're not talking about it. But 378 million is export metallurgical coal. 147 million is for domestic use. So the majority of AMR stuff goes abroad. This is just in 3 quarters as well. This is the latest quarter. So said the majority goes abroad, which is why you've seen a huge decline in revenues here at 1.3 billion down to 750 million for 6 months 2024 and 6 months 2025, and that is almost exclusively come from this here. unfortunately, for AMR, but that is the way that it has fallen. The US is generally self-sufficient. The US produces most of the metallurgical coal it consumes, 85 to 90%, so it's largely self-sufficient. Premium coal imports. US steelmakers import a specialty low coal from low volume coking coal from Canada or Australia. So I find it quite interesting actually that they don't appear to have quite enough themselves. Yet AMR, most of their exports go abroad. They could just be producing more than America needs, I guess. So I said, do a table showing which countries use the most seaborne metallurgical coal, because the seaborne part of it, the need to import it, to me, logically seems like the place where the majority of the price for this is going to come from. In that, yes, all right, there's domestic use, but the people that are not getting enough domestic use and need to import it, the people that are gonna increase the need for supply. That's the way I look at it. As you can see here, China's seaborne imports, this is 2023, seaborne in share declined 76%, unfortunately. But China is bigger than the next four combined, and this is why China's decline has unfortunately hit the coal market, the metallurgical coal. China remains the largest importer of seaborne met coal, but is shifting towards overland imports, particularly from Mongolia, reducing its reliance on maritime trade. So I question if they're starting to increase the import amounts, would that show a global deficit of seaborne metallurgical coal? Because China is a dominant player in the seaborne market, any meaningful increase in its seaborne imports would effectively create a global seaborne shortage, even if global consumption as a whole isn't increasing. So, that would be good for the price of the metallurgical coal. Let's see. The majority of AMR's met coal is for export. Where does that go? So 35 to 40% of it goes to Europe. 25-30% of it goes to Latin America, 20 to 25% of it to Asia, Japan, South Korea, Taiwan, and 5 to 10% to the Middle East. So little to none goes to China, which means China's decline will actually have very little impact on them. You've got it, right? So ChatGPT agrees with that statement. So if the decrease in demand doesn't affect AMR's business, with China, the only thing that can be affecting that is the fact that China has such an impact on the price of coal. That's the way I'm thinking about it. You mentioned met coal is being phased out for different ways to produce, so there isn't enough global scrap to satisfy demand. So what other producing methods are there? So blast furnace is obviously what the coking coal is used for, which is 70 to 75% of global steel production. It's a huge portion. Electric arc furnace using scrap, so limited by scrap availability, not high enough quality scrap to meet total steel demand, especially in developing economies. So yes, that is something that has definitely grown over the last few years, but you're still limited on what you can do with that, especially in developing economies and all that have not had large steel structures historically or anything like that. They're not going to have enough scrap to be able to use this electric arc furnace way of creating coal. So they'd have to use the blast furnace. There is now a new hydrogen-based direct reduction. So it doesn't use coal, metallurgical coal, and it uses hydrogen to reduce iron ore. Early stage tech, high capex, requires cheap green hydrogen suitable mostly for new greenfield plants. Global scrap availability is 600 to 700 metric tons a year, while total steel production is 1.8 billion tons. So, the scrap is just not there. It's just not going to cover it. Any time soon, I would imagine it's just not going to cover it. I said, if scrap can only supply 25 to 30% of global demand, then the only other option is the met coal is the hydrogen route. So how much does a hydrogen reduction plant cost? Well, a hydrogen reduction plant can range from 1.5 billion to 3.5 billion. So that is a lot of money. Operating costs are closely tied to the cost of hydrogen. Current green hydrogen prices are significantly higher, ranging from $4 to $8 per kilogram over the 1.7 kilograms. 1.7 dollars per kilogram. There is a huge emissions reduction, though. Let's not take away from that. It cuts emissions by up to 85%. Now, that sounds very good. While hydrogen-based direct reduction presents a potential pathway to reduce reliance on metallurgical coal and steelmaking, its widespread adoption faces significant economic and infrastructural challenges. The high cost of green hydrogen and the substantial capital investment required for HDR plants poses barriers to its immediate scalability. So basically, it potentially is a future, but it is not a future that's happening anytime soon. So you will still be reliant on blast furnaces effectively for quite a period of time. Blast furnaces, 2 to 8 million tons of crude steel per year. So large integrated steel mills often have multiple blast furnaces, and a hydrogen-based direct reduction method only produces 1.3 million tons a year. So even when you want to go the greener route, you are miles less efficient at producing it than a blast furnace. That's what that is effectively saying. So I said to produce the same as a blast furnace at a minimum, you're looking at 4.5 billion for an HDR plant to compete scale wise. So yes, effectively, because it costs. So if you want to produce where are we looking here? The potential 8 million tons of crude steel per year that the hydrogen-based direct reduction can create, you're going to need almost 3 of them for one blast furnace, and that would cost at 1.5 billion each, 4.5 billion to produce what one blast furnace can produce, which is crazy. That is something that obviously it will improve as the technology improves, but replicate large integrated blast furnaces iron output, you're realistically looking at 4 to 5 billion in capex for an HDR plant, assuming current technology and module sizes. That's orders of magnitude higher than replacing a small met coal mine, which helps explain why metallurgical coal demand will remain strong for the next decade. Crazy. How much does a typical blast furnace cost to build capable of doing the 4 to 5 million tons? That they say that ChatGPT is saying for a furnace that can do annual iron output. So, what was that question down here? So 2 to 3 billion supposedly includes furnace, coke oven, sinter plant, and basic oxygen furnace. If you like, I can make a side-by-side table comparing blast furnace and HDR, including capex. So if you wanted to do 4.5 million tons, it would cost you 2 to 3 billion for a blast furnace. If you wanted to do 1.5 to 2, you're looking at 4 to 5 billion for a hydrogen direct reduction plant. It's unbelievably more expensive compared to a blast furnace, which is why blast furnaces, it seems, are going to be around for a while yet, until the technology, which, inevitably will happen. It always happens eventually. But until the technology builds up to do that for the same construction time, 4 to 6 years construction time, 4 to 6 years construction time. But you need the hydrogen infrastructure going in then as well, which is a complicated thing. Hydrogen is not easy to store. It can be very, very dangerous. So yes, from a carbon footprint point of view, it seems better, but from a business point of view, to me, it doesn't seem any better than a blast furnace currently. How many blast furnaces are being built compared to HDR plants? How long does a blast furnace last compared to an HDR plant? Because that's another thing as well, right? If you're going to spend 4 to 5 billion on something, it's going to create less coal in a blast furnace. You'd hope that it would last longer. Doesn't, apparently. A typical blast furnace lasts 25 to 30 years. A hydrogen direct reduction plant lasts approximately 10 to 15 years. So it could be anywhere up to 50% shorter life for that much more money. Operational lifespan could be extended with refurbishment subject to HDR plant is subject to technological advancements and maintenance in order to make it last longer. Longer intervals due to high capital investments, that's a replacement cycle. Shorter intervals potentially leading to more frequent upgrades. So at the moment, it only seems to be the lower carbon footprint which makes it more appealing, which is obviously something that is more appealing in the long term. But businesses, especially in, what would you call them? Non-first world countries, like emerging markets and all that, they're almost certainly going to be looking at a blast furnace just for the longevity and the cost. That's my opinion anyway. There's not many countries outside of the West that truly care their carbon footprint. And that is just the reality of it. You only got to look at what China's done with their carbon footprint over the last, 10 years. What everybody else does effectively doesn't matter. If places like China are still producing carbon footprints like they are, what everybody else does effectively makes no difference at all. And these emerging nations, I would assume, considering the lifespan and the cost, would probably go for a blast furnace over a hydrogen direct reduction plant. That is my opinion. Whether or not that's true, though, I don't know. So HCC, Warrior Met Coal, which is another one that Mohnish Pabrai owns, 100%. So I'm just looking for comps at this point now. 100% of their production is metallurgical coal. They export it globally. And the other one that I went for was this, because they're focused on met coal operations in Central Appalachia. Most other ones are, focuses on thermal coal, operates primarily in Indiana, produces both thermal and met coal. It's a bit more difficult to break down, but AMR is the leading producer of met coal in the for US publicly traded companies. So they are the comps that I used. So I just said, like, here, if the majority of AMR's met coal is exported, which markets have declined, so apparently it's Europe. Mainly it's Europe. Revenue declined due to lower prices and soft demand. The weak steel demand in Germany, Italy, Spain, oversupply of seaborne met coal from Australia and Russia post-2022. Brazil steel production growth has slowed. Mexico is steady, so it's only had a moderate impact on AMR's revenue. And South Korea demand is stable, imports largely unchanged, so minimal impact on revenue. Any other region, opportunistic sales, some markets depressed due to regional competition, so small impact. So the main impact has come from Europe. Weak steel demand, Germany, Italy, and Spain. That's where the main impact for AMR appears to have come from. What else have we come up with here? So AMR's Q2 25 results highlighted a significant revenue drop of a 31.4% decrease and a net loss of 4.95 million. The company attributed this downturn to weak coal demand and global economic slowdown, particularly noting challenges in key markets such as Europe and Asia. So I said, like, what future guidance have they given, like revenue-wise or margin-wise? So AMR maintains a positive long-term outlook for metallurgical coal demand, citing forecasts of increasing global steel production and potential decline in coal supply post-2028. So they effectively think that the oversupply is going to last that long, but because nothing new is really coming on until at least post-2030, you could see prices rising again in 2028. So if you were to be interested in this because of Mohnish Pabrai and not because of me. It seems like it's a long-term trade, a reasonably long-term trade. You're looking at 2028 before AMR predicts a change in the metallurgical coal supply. Currently, you can buy the company at 1.7 billion. So they haven't committed to any revenue guidance. AMR committed and priced approximately 69% of its metallurgical coal for the year at an average price of $127 per tonne and 100% of its thermal coal. But I said we're not so concerned about the thermal coal. It doesn't make up a large enough portion of the revenues. The lower estimate of 13.8 million tonnes, $127 per tonne, would mean that they're going to make 176 billion. So we go at 1.8 billion for 2025. I said our margins expected to get worse. I noted you earlier stated they're trying to cut costs to help, so that's good. I'll tell you what I will find, and we're probably getting on to the point where I can move on to it now. AMR is doing the right thing by cutting costs, but gross margins are expected to remain under pressure in the near term, with revenue declines outpacing operational swings. Outpacing operational savings. So if we actually have a look at the cost of goods sold for AMR, I think they're reasonably consistent. Even when revenues go through the roof, the cost of goods sold are reasonably consistent. So the only difference is the amount of revenue incoming, which to me suggests that it's almost exclusively their free cash flow or their earnings is almost exclusively determined by the price of coal. You've had a huge increase in revenues while the price went up. Here you go. And now obviously it's come down and you've had a significant decrease in revenues, but the actual cost of those revenues throughout has remained reasonably consistent. So they do show as well. Let's see if I can find it. So basically the average EV to EBITDA is around 7.6 to 10 on a forward basis. That's for the industry, but they have slowly scaled up the amount of coal that they are producing. So for AMR, so you've gone from like 12.3 million tonnes to 15.3 million tonnes, and in that time, you've actually not really seen. So the amount of mining has gone up slightly. Have not really gone up. 2022, 2.3 billion cost of the revenue. 2025, 2.3 billion cost of revenue. So it's not the cost of mining the coal is causing the income issues. It is literally the revenues coming in, which is solely determined on the price of the coal. That is the determining factor in what has gone wrong with their revenues. So if we're going to go to future and net present value, this is the problem though. This is what is showing that it really ultimately is probably fairly valued at the moment on what you can see. Trying to say here during this time, I've made some notes down here, just lost screen as well. So the coal prices are suppressed because of the downturn in China. Now, downturn in China is not necessarily going to last forever. Coal prices have historically been significantly higher than where they are now. So you could potentially see an increase in revenues of 30 to 40% potentially if you go up to this channel. I don't know if this is a correct channel, by the way. I've just gone from the fact that we've got some lows down here and then the center line sort of passes around here. There's a bit of technical analysis on it. you potentially could see from 2028, say, when they believe that there's going to be a lack of supply, and bear in mind that there's no new build mines coming online before 2030, you could almost certainly see an increase in the coal price. And obviously an increase in the coal price is, if it went up by 100%, their revenues is going to go up by 100%. And historically, if you look at it, if their revenues go up by 100%, cost of goods sold to produce, a similar amount of coal, but the revenues have gone up double, still only going to be around about what it is now. So this is why you've ended up with, $1 billion in free cash flow. I can certainly see where Mohnish Pabrai is coming from. I think it is a very long-term play, and he's happy with that. Said you could be purchasing $1 billion in revenues for 1.7 billion. Do they pay a dividend? They do, but not really of any significance at all. It has been of significance. They have slowly decreased their share count as well, which is obviously shareholder positive. But there are a few things going for this, really, in the long term, as in I can see why Mohnish Pabrai is interested. The replacement cost is huge. 4.5 billion to reproduce. This is on the low end as well. When you're talking 5 years to be able to do it, so in 5 years' time, that cost invariably is almost certainly going to have gone up. So 4.5 billion to recreate what you can get for 1.7 billion is your first thing. The cost of producing the coal not really changed. The global demand has changed. Should global demand get back to similar levels, of what we're looking at previously, you could end up being again in a position where in the space of a couple of years you could buy out the company just from a simple free cash flow. So what I'm saying is I understand Mohnish Pabrai's thesis, and currently it looks like it's probably fairly valued for the way the market is at the moment. But question is, and this is obviously what Mohnish Pabrai has taken the bet on, is the way the market is at the moment near a bottom, which, should this channel be correct, you're not far from it, or in which case it's only going to get better up here. Your revenues are going to increase and get better, or is it not the bottom? And he must be gambling, in my opinion, on the fact that it potentially is the bottom. And the analysts as well believe that there will be a decline next year, and there will be some sort of some sort of stabilization 2027, 2028. And in 2028, AMR expects to see a stabilization and possibly undersupply of coal. So, very good balance sheet. Reproduction costs are ridiculously high compared to what they are now. We've seen that it's not going to be possible to completely, whether people like it or not, it's not going to be possible to completely get rid of blast furnaces. In fact, I would say it's probably almost impossible. There's not enough scrap to use the arc reactor plants. There is a huge cost to using hydrogen reduction, and hydrogen reduction doesn't last as long as a blast furnace. It's a lot more to do and has a shorter lifespan. Now, the emerging nations are not going to be people that want something that is not going to last long for that price. What was it, twice, 2 to 3 times higher, and lasts 50% of the time? It's not a good business decision for emerging nations that haven't got the money to spend on that. So, interesting. The metallurgical coal is a very interesting market, and I can certainly see why Mohnish Pabrai is in on it. Now, all I've done here, though, is break down what I believe his thesis to be. He has broken it down several times, so I've long-windedly told you something that he could probably tell you in 10 minutes if you go and look at his videos. That's what I said right at the start. If you want a better version, go and listen to him. He knows way more than I do. He's a very successful investor. But I wanted to, after seeing that 16 million insider purchase, I wanted to try and break it down myself and see if I could see the same thing. You know, like Mohnish Pabrai says, shameless cloner. Be a shameless cloner, learn from other people. So that is what I have done here, and this is what I have broken down in this video for other people to see. It would be interesting if other people watch it and will comment on what they believe it is, or whether or not I've hit the nail on the head. Yeah, I'm going to leave this video here, but this has absolutely not been a endorsement to buy this. Do not do that off of my advice. All I've done is vlogged my learning experience of trying to break down somebody else's trade here, which I didn't have any intention of doing until I seen this insider purchase, and this insider purchase is so juicy. 16 million. I was like, well, we got to have a look at it. Got to have a look. That is where we are on this. 20% of Mohnish Pabrai's portfolio, 2% of Towel, which I know is one that Roaring Kitty kept an eye on. Hosking. Yeah, Jeremy Hoskin. So, yeah. Nobody else has got as high convictions as these people up here. I wouldn't say 2% is high conviction, to be honest, but, you know, who's got the most ownership? BlackRock, Vanguard, State Street, Standard. Interesting. And you've got a good amount of insider ownership as well. So definitely an interesting one, this one. Very difficult to model what potential future free cash flows are going to be. Mohnish Pabrai has just taken an educated gamble, an educated guess on the fact that you are going to see coal prices return at some point in the future to what they were. And his whole thesis is based around that, because if they are, then this company is going to be printing money. If they do, this company's going to be printing money, especially, like I said, when their average costs of doing business no different now than what it was in 2022. You know, is there anything? No goodwill, which is good. There's very little intangible assets, which is good. So yeah, like it's very interesting actually to know that, you know, the tangible book value is 120, but actually the tangible book value could be, you know, like 3 times higher than that if you were to do the replacement cost on that. Very interesting. When did they stop paying? Let's see if I can AMR up. Here, he last paid a dividend in 2024. He's not paid one for a while. What's this here? Alpha Metallurgical, initiated by Tech Capital Securities. Never heard of them, but someone that says they're buy. Sees imminent danger order. Oh dear. Currently up 8 consecutive days. Requires 108,000 shares. Mine worker dies. That's unfortunate. interesting. It is effectively a global macro play, this one, but you know, if you are close to a bottom on the price of coal, let's just ask what our expected coal expected met coal prices post 28. Has anybody done analysis that further on? It's probably very difficult because you are then really gambling and guessing on what global factors are going to be. Is inherently speculative, exactly. Premium met coal's historically traded $200 to $250 a ton range. Oof, really? I mean, it has. But I suppose the median line would be around that area. Be interesting. $50 is a 30% increase in revenues. Let's just see if we can work something out here. 2.3. 0.5. So that would take revenues up to over 3 billion. And if the costs are not going to be very different at all to what they are now, you could be looking at significantly higher simple free cash flow. The average simple free cash flow margin is anywhere between 5 and 10%, I believe. That is up here somewhere. Where did I do that? Is in here somewhere. It's going to be a very boring part of the video now. Margins, right. So there you go, free cash flow yield, not margin, different. 5 to 15% depending on factors like coal prices. So where are we here? Cash flow yield, where have I got this? I mean, they're definitely on the higher end of that range, aren't they? Definitely on the higher end of that range. You could be looking at significantly higher free cash flows should prices ever trade up there again. And Mohnish Pabrai has made a bet on the fact that they will. All the evidence we've seen here today suggests that it makes sense, but there we are. Don't make an investment on anything I've said here. Absolutely do not. It's got to be a long-term play by the look of it. It has to be a long-term play. That's why in his recent interview about his fund, basically said he's very happy with all his metallurgical coal trades because his timescale is not tomorrow. His timescale is probably up to 2030 when the other mines start opening, and then obviously it ups the global supply. If you're looking for 2028 to 2030, then I guess it could be where he's looking, you know. Yeah, interesting. But it is an interesting one. Hopefully we've learned a lot about the metallurgical coal market today. I'm going to leave this video here. Do not make an investment on anything that I've said. Just vlogging a breakdown of Mohnish Pabrai being a shameless cloner like he's informed us to be, just to see whether or not I can see what he sees, you know. And we'll leave it at that. So thank you very much for watching. Like and subscribe, and I'll see you on the next one.